I think, that's specific to the equity market. Certainly we're
Okay.
seeing in other markets,
energy,
whether
yeah.
it's bonds or gold or Bitcoin, that there is some kind of reaction to the news. But then, for equity markets, they're pricing in real-time information, but they're also forward-looking. So trying to kind of understand what's the second and third order impact of this very severe shock is going to be harder, right? So I think, there could be two scenarios. One is the market is just telling us, we just don't know. Does anybody really know? And we'll wait and see because we've been burnt before. Or another one is that if you look in history, historically, markets have absorbed geopolitical shocks, whether it's 9/11, Russia, Ukraine, global pandemics, it just moves on and it continues to go up. So, that could be a second scenario. But I think overall, we should always be asking, is it different this time?
Is it different? Yeah.
I mean, potentially, because if you look this time, the U.S., on the one hand, you have the U.S. is, we have oil now, right?
Yep.
So it's less dependent on global oil. But on the other hand, we're trying to isolate ourselves more from global impacts. So we're isolating ourselves, which is what we intended to, but then the rest of the world is realigning itself and potentially realigning towards China. So, you have all these factors to play with, and then you have that markets just return 11% every year.
Right. It's interesting. I mean, when we see, I guess we're all learning together kind of the choke points and the importance of the oil coming out of the Mideast. Less important to the U.S., as you mentioned, because the U.S. has now, over the last 15 years, become energy independent. But boy, a lot of the rest of the world, Asia in particular, some parts of Latin America, really, really dependent upon that flow of oil. And that kind of brings into the global economic slowdown concerns, which in fact then will impact the U.S.
Right.
It's tough to kind of think through that.
There's definitely this chain reaction. It's not just about oil, it's about food, it's about, how
fertilizer. We've seen fertilizer prices spike
and
just this
every
week.
single industry needs energy to support it. We also have AI energy use, so all of this will have material impacts the longer, oil is at 100 or 150. But, you mentioned emerging markets. It's interesting because we're looking at that space as an opportunity because, emerging markets have proven themselves quite resilient. They've been through a lot of shocks before and they've managed to pivot very quickly. They're coming out of this, with the better fiscal resilience, also better than developed markets. So we see this also as an opportunity. Yes, there's volatility and there's uncertainty, but certainly there's a lot of opportunities in this space, and not all emerging markets are the same. You look at Latin America, which is more commodity exporters. They're doing really well. I look at countries like Brazil, interest rate at 15%. There's going to be political uncertainty, but they're managing very well through all of this uncertainty. And then even emerging markets, we had Korea, single worst, drawdown in its history, but year to date, it's still up 30%. Emerging markets still performing better year to date than the rest of the world.
You mentioned emerging markets, but you also mentioned gold in your notes. So that's another place for opportunity you see, value?
Yeah, so similar to how we're seeing all of these other asset classes that have these huge ramp up, huge momentum, you're going to see some pullback. It's risk off, right? And gold doesn't seem to be acting like it's hedged for a risk off situation, but you have to think about the ramp up it had with all of this liquidity coming into the market. So we're seeing some of the marginal investors taking money out, taking profitability, but if you look at the long-term trend line, it's still the best performing asset class over 20 years, still up 1 year, still up year to date.